every time there's a global crisis. Most people panic, they're all over the place. Smart people take advantage of the situation. That's why these strategies will work whenever there is fear and panic around. So today I'm going to be running through how you can make millions from the coronavirus market crash and any recession causing crisis in the future. By having the right finances in place, I was able to ride out the last two recessions and grow my business back to full strength in an incredibly short amount of time. Before implementing anything, make sure to speak to a financial advisor about your individual situations. Let's first break down what a market crash is and why it's happening. Our economy has seen incredible growth over the last decade. It's been up, but now recently it's come to an end and it's started to crash. Now, when companies are making more money, it of course creates more demand for jobs. And when more people have jobs, they earn more money. Now, this chain of events is extremely delicate. If just one link breaks, such as people not spending money, then the whole system, it just collapses around us. We are currently seeing a chain of events break down on a huge scale, partly because of the virus, but mainly because of the mass fear caused by the media. It's not the end of the world, like the media would like you to believe. Their main aim is to get more people watching and reading the news, as they can make more money from advertising revenue that they depend on. On top of this, there are huge disruption problems to supply chains, especially people like Apple and Amazon who depend on all of these items coming from China. It causes a trickle-down effect. This is why you may have seen bare shelves in the shop and people even fighting over toilet rolls. Who would have ever thought that? Lots of investors see this unfolding and start to panic. They sell off stocks and shares. Now, the biggest takeaway from this is that fear is the number one enemy of the stock market. But do you know what? It could be your number one friend. In situations like these, you have to adapt, just like a virus. Look for the opportunity and don't become paralyzed or overanalyze everything. Be smart and take action. Even if it's not perfect, just take that action. Without any further ado, let's jump in. Number one, reduce your spending and build a safety fund. Be unbelievably stingy. Put it all towards building a safety fund. If you don't already have one, it's the most important thing you need to do. This safety fund should consist of 3 to 5 months of your living expenses and only used in an absolute emergency. Now, this safety fund is like your protective shield. You can hold it up, hold it against everything. It's going to protect you against unexpectedly getting fired or if you have a slow month with your own business. But most importantly, fear won't affect you in the same way. Number two, index funds. Now you have your safety fund, you can afford to invest the extra money that you have coming in into an index fund. These funds are one of the safest long-term investment strategies you can take advantage of. Now, index funds are comprised of lots of different companies, therefore they can go up or down with the market. Because people are currently scared, the market has dropped in value dramatically. Now, my prediction is the market will be worth a lot more money in a year from now. If things start to improve with the current situation and people start getting better, then it will kickstart the chain of events and the market will bounce back dramatically. I wouldn't recommend this strategy to anyone that isn't prepared to invest for at least 5 years. Now, one of the most popular index funds is called the S&P 500. This is comprised of the biggest 500 companies in the USA, such as Apple and Amazon and Microsoft. Now, the amazing thing is that buying and holding this fund for a 20-year period has never lost anyone any money. Just let that sink in. Over a 20-year period, it has never produced a negative result. So come on, Mark, I hear you say, how do I get started? Now, I love using Vanguard index funds. You can just jump in their website, it's really easy, open an account, you can pick your own risk tolerance. Now, general rule here is the older you are, the less risk you should take. Don't be put off by the complicated words. Do some extra research around what funds are best for you and start investing consistently each month, the same amount, just keep investing. If you can make it automated, then even better. Like the saying says, the best time to plant a tree was last year, but the second best is to do it today and get going. The main thing to remember is don't panic when your investment goes down. Don't even look at it, because if you leave it there for long enough, you're going to make a...
Now, lots of people will try and tell you that becoming rich is easy, probably because they want to sell you some sort of get-rich-quick scheme. However, this isn't the case, especially at a young age. It's not impossible to become wealthy, but you do have to be very strategic. I'm not pretending to sell a magic bullet. In fact, I'm not selling anything. I just enjoy sharing my many years of experience, and I personally believe by avoiding these 8 things, you'll have a much higher chance of becoming rich. Hi guys, it's Mark. So let's make money interesting so that you can grow your wealth. First up, we have extended warranties. I have to say, they're one of the biggest scams out there. Well, apart from the Squid Game token, that's for sure. I learned this when I bought my first method of transport, a Yamaha DT100 motorbike. I paid for an extended warranty, which they added to the monthly payments of the bike. Every month they were feeding on my bank account like some sort of vampire. The worst thing of all is I didn't need the extended warranty, but the salesman used fear tactics to pressure me into purchasing it. Just think about it, when you buy a new PC, the chances are the retailer bought the PC from a third-party supplier, meaning the amount of profit they make is very small. That's why it makes sense for them to push an extended warranty onto you. It's where all the extra profit is made. What people seem to forget is a lot of credit cards offer an extended warranty, so you can just purchase an item on your credit card to get the same protection, and you pay no interest as long as you pay it off at the end of every month in full. Most people just completely forget that they have an extended warranty, not to mention the fine print, which usually makes it very hard to make a claim, so it's good as throwing your money down the drain. Normally they ask you if you want a 3-year warranty. However, the manufacturers cover the first 2 years anyway. So the reality is you're only buying an extra year anyway. So honestly, when you factor in your consumer rights and using a credit card for payment protection, why would you need an extended warranty? I bet a lot of shops don't want you to know this. Number 2 is new cars. What if I told you that a new car was the #1 killer of wealth and financial freedom? The untold truth is that a lot of people take on car finance to look and feel rich, but most of the time they don't even own their own home and are living paycheck to paycheck. I was looking to buy a new car when I was around 19 years old, and I was amazed to find out that I could buy the same car pre-owned for around half the price. So from that point on, I promised myself that I wouldn't buy a new car unless I really wanted it and I could buy it from my passive income. In fact, I actually bought my first brand new car when I was in my early 30s, and it was for my wife. The first time I bought a new car for myself was around the age of 35. I am such a loving husband though. I now have a Tesla Model 3 as it's a great write-off for my businesses, but I still spend most of my time driving around in my old van from A to B. So many people finance their cars, it's gotten to the point that car dealerships don't even tell you how much the car costs. They just ask you how much you can afford every month, and if the car seems too expensive, they just lengthen the payment term so it seems cheaper. Those cheeky chappies, you gotta watch them. The average car payment in the USA is between $500 and $600 every single month just to drive a fancy car, and even when it's paid off, most people just keep upgrading as it's a status symbol. It's like an endless cycle of flexing. Just to drive this point home, average stock market returns are 10%. If you invested $500 a month for 30 years, you'd have over $1 million for retirement, and that's going off 10%. And we've all seen the crazy crypto returns lately, so just use your imagination of what's possible. Talking about crypto, if you want to grab $10 worth of free Bitcoin, then for a limited time, Coinbase is giving it away when you open an account. I'll leave the link below. Third, we have penny stocks. While it's true people have made a lot of money by investing in penny stocks, it's a real gamble. Believe it or not, the average annual penny stock return is actually minus 30%. Penny stocks are extremely high risk investments that usually have very little information and history, as the companies can be relatively new. This could be an absolute recipe for disaster due to the pure volatility of the stocks. Small market caps and low liquidity means it's far easier to manipulate the price of the stock. For example, the big stocks like Tesla have market caps far in excess of 1 trillion, so a few whales selling hardly makes a difference to the price, whereas a penny stock typically has a market cap of under 300 million. So all it takes is a few big sales and it can send the stock through the floor. I invested in penny stocks when I was younger and I had some great luck. This was back in the days of the Wolf of Wall Street. They used to have huge rooms full of salesmen on the phone pumping up the prices of whatever penny stocks they liked. These were known as boiler rooms. This was also they could sell at the peak and make huge profits for themselves. I think I got lucky and jumped in on a few of these penny stocks and sold before the whales, leading to a nice profit. So you may be thinking, why have I put this on the list? Well, the truth is that I got lucky, and looking back now, the potential downside was really not worth the risk. Number 4 is eating out regularly. Now, I don't want to seem like a downer, but the average American household spends $3,000 plus per year on eating out, and that's not even accounting for alcohol as well. When I was building my wealth, I always saw eating out as a waste of money, and therefore never fell into this trap. I learned how to cook at school, and I still enjoy cooking now when I have the spare time. Not to mention, cooking at home is generally a lot healthier.
Well, your body is a temple, Dad.
Yeah, probably Buddha. I think the bigger issue here is drink. Not only does it hold you back financially from your goals, it can also throw you off your game the next day, which is never good. I believe in maximising every day, and successful people don't have time for laying around all day with a hangover. The richest CEOs in the world, like Elon Musk and Jeff Bezos, probably don't mind a drink, but they're certainly only keeping that sort of thing for special occasions. Next up is expensive gifts. It's so easy when you're young to think your friendship group is amazing and you're going to be friends forever, but that's just not the case. I often sit back and reflect on how far I've come, and when I look back, it's amazing how many people have come and gone from my life. Maybe this is because I never bought them expensive gifts. But seriously, when you're young, no one expects you to buy luxury gifts, and if they do, then, to be honest, they're no friend to you. I never saw the point of buying expensive gifts when I was building my wealth, and my girlfriend, now my wife, has never had any problem with that. If love is in your heart, then it doesn't need to come out of your wallet.
You should consider being a dating coach, Dad, with advice like that.
What can I say? I've still got it, son. But seriously, with all that said, it's important not to waste money on expensive gifts, especially for people that could end up being temporary. Every single expensive item you buy for yourself or someone else is a major setback, as early on in your journey it's the most important time to be investing so things can start compounding. I'm not saying you can't buy cutting grass so he could provide for me and my mum and my 3 sisters. He'd stash away any extra money he made in a shoebox, as well as a bank account that paid little to no interest, hoping that one day he could quit his job working in the factory. When my uncle invested some of his money in the stock market, my dad said it was an extremely risky move. Unfortunately, what my dad didn't realise is that he was also playing a risky game. Can you see where this story's going? Every year my father's money was losing value due to inflation. This is just what happens over time. As more money is printed, the money in circulation becomes less valuable. This meant he was never able to quit his job in the factory. The thought of my money being eaten away by inflation scared me so much that I've made sure to invest throughout my life. As a result, not only have I beaten inflation, but my investments actually now grow by around $17,000 a week on their own, which over my lifetime has made me millions. I'm no financial advisor, but I am someone that's been there and done it. That's why I'm making this video. It's exactly what I wish I had when I was younger. How can I make money investing in stocks? To make money, we first need to beat the inflation issue. In the last 60 years, this averages out to a rate of 3.8% per year. So if your money isn't growing by more than this on its own, then you're getting poorer by the second. In a perfect world, you would have a savings account that provides an average return of 8 to 10% every year, so that you can both beat inflation and earn some profit. Unfortunately, such savings accounts don't exist. However, you can achieve returns like this by investing in the stock market. A stock is a small part of a company, and when you buy it, you become a shareholder. And when you're a shareholder, there are 2 ways you can make money. Firstly, if the price of the stock goes up during the time you own it, you can sell it for more than you paid. Secondly, you can receive dividends. Dividends are regular payments to shareholders. Not all stocks pay dividends, but if they do, this means that you can receive money without ever selling your stock. The magic really starts to happen when you own a bunch of stocks that grow at an average of 10% per year, because the interest applied becomes larger and larger. This is called compound interest, and I have to admit, a guilty pleasure of mine is messing around with online compound interest calculators. Let's do one now. If you were able to invest $250 per month at an 8% annual return, in 42 years, you'd be a millionaire. And if you continue to do this for another 10 years, you would actually have over 2 million in your account. Of course, if you wanted to invest even more, then that would just speed up the process. This is all based on historical average data and it isn't guaranteed, but it's certainly been my experience. So as you can see, the real secret ingredient to this millionaire formula is time, which brings me on to when should I start investing? The short answer to this is as soon as possible. The younger you start, the better, as you're giving your investments more time to grow and compound. This also means you can take more risk, as your investments have time to recover if a stock market crash happens. And it will happen. It always happens. But life isn't as easy as this, as there are often things in the way preventing you from investing. So here's how I would structure things. First, you need to make sure you've paid off all high interest debt like credit cards. Just think about it. There's no point trying to make 10% in the stock market if you're paying 15% to a credit card company. Secondly, build up an emergency fund. This should be enough to cover 3 to 6 months of your living expenses. This way, you're not forced to sell your stocks in the event of an emergency, which can really ruin your progress. Once you've done both of these things, you're ready to start investing. If you're younger than 18, then it would be a great idea to ask a parent to open up a custodial account, which allows them to invest for you. This will give you such an advantage in the future. Your next question is probably something along the lines of, how much should I invest? When you ask an investor, they'll probably say as much as possible. However, I have a different opinion. I made most of my money through starting different businesses and only used the stock market to grow my wealth over time. I've also had a pretty fun life, from flying full-size aeroplanes and racing cars to competing for my country and traveling the world. If I'd invested all of that money into the stock market, then I'd have missed out on so much. So my answer would be to invest whatever you feel comfortable with. But if you want a more solid answer, then the 70-20-10 rule is a pretty good guide. It states that you should split your money by these percentages: 70% on living expenses, 20% on investments, and 10% on the fun stuff. Research shows that people who invest at this level are much better equipped to ride the ups and downs of life and also get ahead of everyone else. That's all well and good, but how do I buy a stock? There are various different apps out there that allow you to invest in stocks. I'll leave some links below. The key is to open the correct type of account. You'll often hear people throwing around the terms Roth IRA in the USA and Stocks and Shares ISA in the UK, TFSA in Canada and Supers in Australia. If you don't have one of these accounts, then you're missing out, as they allow you to avoid paying taxes on your investments, but they do have limits because they're so powerful. A great thing about these investing apps is they actually give you the ability to buy fractional shares. So rather than buying a share of Apple for $190, you can invest as little as $1. I wish I had this option when I was younger, as it would have allowed me to get some early investing experience without having to take any big risks. One of my favourite investing platforms is Trading 212, as they do both of these things. Since I was planning to talk about their app anyway, I reached out to see if they'd be interested in sponsoring this portion of the video. They agreed and are also offering a free stock worth up to £100 to anyone that uses the code Tilbury when they create an account. One of the really cool things about Trading 212 is they let you practice investing with fake money, so you can get familiar with real data from the markets without risking any money. So if you're a little uncomfortable with investing or just want to try some strategies before putting your own money on the line, this is a great way to get started. Another great feature is called pies, where you can see how other investors have allocated their money into different stocks. If you wanted to invest $100 into that pie, then it would just be split amongst the various allocations that pie creator has chosen. If you live in the UK or Europe, it's worth trying out Trading 212 because signing up is completely free and there are no commissions. Of course, don't forget to use the code Tilbury and you'll receive a free share worth up to £100. Or alternatively, click the link in the description to sign up and see exactly how to access the free share. Now the obvious next question is, how do I pick the best stocks? There are two main ways to attempt to predict the stock market. These are called technical and fundamental analysis. A good way to think about this is like a scale. Usually, short-term day traders are purely focused on the technical aspects. This includes looking at charts and patterns. They believe they can predict how the stock will change in price by judging the highs and the lows on the graphs. As a long-term investor, my strategy is about keeping it simple. Lots of people talk about using margin and options, but that's really not something I worry about. I'm a lot more focused on the fundamentals of a company. This includes the financials, the leadership, and the brand recognition, as I believe this is where the true information lies to indicate the long-term success of a stock. When I invest in a stock, I don't have an intention of selling it for at least 2 to 5 years. However, like I mentioned, it's a scale, so I do look at the occasional chart in order to find the best time to buy. This approach has helped me find some really good investments over the years, rather than just dipping in and out trying to make a profit every day. But with the majority of my investments, I don't actually do any of this. That's because I allocate most of my money to index funds. This is definitely the best strategy for most people. So, what's an index fund? It's a way for the average person to make more money than the professionals with very little effort. I'm a big football fan, and if you've ever followed any sports, you'll be familiar with a league table like this. The better your team performs, the higher up they'll be on the list. On the other hand, if they do really badly, they might be removed from the league entirely. This is almost exactly the same as an index. All you have to do is switch out the teams for companies. Let's take the S&P 500 for example. This is a list of around 500 of the largest public companies in the USA, the big dogs being Amazon, Google, Apple and Tesla. Just like the league table, if a company does poorly, then they run the risk of being removed from the list. With this league table or index of companies, you could go and buy stocks in some of them individually. However, if something bad happens to those companies that you've picked, then you can wave goodbye to your money. The idea of an index fund is to be a little bit sneaky, as it allows you to invest in every single company on the list with just one click. Even if a few companies do terribly, then it's balanced out by all the companies doing extremely well. The average annual return of the S&P 500 over the last 10 years has been 13.6%, although this is slightly higher than the average over time. No one has ever lost any money if they've bought and held an S&P 500 index fund for more than 20 years. The truth is that the average actively managed fund returned 2% less per year than the market in general. This means that the professionals on average are doing worse than index funds, and even if they end up losing you money, they still charge you high fees, no matter what. The reason that index funds can charge really low fees is because they're passively managed, which means they look after themselves and don't need an expert to keep adjusting them, meaning the fees can be as low as 0.02% per year. When I tell people about index funds, it often blows their minds. However, when they go onto an investing app, they get confused at the different options and ask, what's the best index fund to invest in? Well, as I said, I'm not a financial advisor, but I have had a lot of success with 3 different types of index funds. Number 1 tracks the S&P 500 index. This is the one we briefly mentioned before. The historical return of 8 to 10% has allowed me to generate a fortune over the years. This is due to the power of compound interest. The S&P 500 tracks 11 different industries/sectors, and no sector is more than 30% of the index. However, it is worth pointing out that it's a bit tech heavy these days, with 5 tech stocks dominating 23% of the entire fund. It's up to you if you see this as a positive or a negative. I personally don't mind, as I believe in the future of technology. There are so many different index funds that track the S&P 500, so here are some of my favourites. The best I found in the USA are the VFIAX index fund or the VU ETF. The best in the UK would probably be the VUSA ETF. The only real difference between an index fund and an ETF is that the ETF can be purchased or sold at any time throughout the day, just like a stock. Index funds can only be purchased in full. So for example, if the price is $500, you must pay $500. An ETF, on the other hand, can be purchased in fractional shares, which means you don't have to buy a full share, and instead you can invest whatever amount you like. This is great if you're just starting out or want to dollar cost average in. Personally, I've set up a direct debit every month so the money leaves my bank account without me even noticing. Really and truly, there isn't a huge difference between an index fund and an ETF. Just consider which one is best for you. Take the plunge. Number 2 is a total stock market index. The total stock market index has returned investors an average of 13% each year over the last 10 years, which isn't bad at all. It's the definition of diversification. You can't really get any more skin in the game for a lower cost. If you want to invest for a long period of time, probably know I've got a bit of an obsession with turning $100 like this into as much as possible. And I think $100 is the perfect starting point, as I feel that most people will be able to find this amount of cash by doing some sort of side hustle or working some overtime. Today I wanted to do something a little different and introduce a time limit. So all the money making ideas I'm going to be discussing with you today should be able to turn $100 into $1,000 consistently over a 24-hour period. But Mark, if it was really that easy, everyone would be doing it. Well, this certainly isn't going to be easy. So if you think that, then please stop watching the video right now. I'm not going to lie to you, this will be hard, but the rewards are definitely worth the grind. But seriously guys, I've always believed that getting rich is entirely possible. However, getting rich easily just doesn't really exist. So I'm going to be starting with the least risky ideas and working my way up to the riskiest ones. But before we get into this, make sure to hit that like button for the LTube algorithm, as it really helps get this video out to more people like you. The first one is creating digital products. I'm putting this as number 1 on the risk scale, as you might not even need the full $100, provided you've already got a laptop or a PC. The internet is definitely the place to make lots of money, as its growth has been absolutely huge. Just in 2020 alone, there were 305,000 online businesses created, compared to just 13,000 in 2019. With all these people starting online businesses, you may think that the competition is going to be sky high, and yes, of course it's harder. However, I think there's a huge gap in the market for digital products. Just think about it, everyone is talking about e-commerce and drop shipping, but far less are actually selling quality digital products which have the benefit of never running out of stock and no shipping costs, as it's all done over the internet. The thing I love about digital products is it can be fairly passive. Of course, no income is truly passive, but if you can create a digital product once, you can sell it over and over and over again. This sounds great, but what actually is a digital product? A friend of mine created a digital template system you can use on Instagram just off the back of a problem sent in by one of her followers who wanted to stand out. Within a couple of hours and no more than $100 invested, the templates were designed, and now she sells thousands of dollars worth every week. So you could use your $100 to buy some editing software to create these products. Or you could even pay someone on platforms like Fiverr to do the work for you. Then you could list them on websites like Etsy and start making some sales. I've seen these templates selling anywhere from $5 to $100 plus, and you only have to make it once and it sells again and again. That's the beauty of it. Once you've got some more money to play with, nothing is stopping you from running adverts on Facebook and reaching even more customers. But if Instagram templates aren't for you, then it doesn't stop there. You can make software, YouTube banners, ebooks, games, email templates, or even online courses. Creating and selling online courses is a booming market internationally, and in my opinion, it's one that's lacking a lot of quality. There's a massive demand for quality courses that teach useful skills rather than all the fake gurus who sell theirs for $997. I feel like they have given the e-learning market a bad name. However, it's expected to exceed $325 billion by 2025, and with a yearly growth of 5%. The second one is starting a service-based business. I'm putting this at number 2 on the risk scale, as the initial setup is pretty straightforward with only $100. This type of business is only really limited to your time. If you're prepared to put in lots of work, then you will be able to turn your $100 into $1,000 consistently once you've built up your client base. Some jobs you can make an absolute fortune from doing because your customers don't feel it's worth their time. And I have to be honest, I agree with this. I'm typically busy with business and it doesn't make sense for me to waste 2 hours washing my own car when I could just pay someone $20 to do it for me. And this is something you can take advantage of. Washing cars could be a great service-based business to get into, but it probably won't make you $1,000 a day unless you become a professional detailer or start employing your friends to work for you so they can serve more of your customers. Once again, it's all about getting creative with the service and value you can provide your potential customers. My son Curtis is 23 and he is behind a lot of the strategies that helped my YouTube channel grow from 0 subscribers about a year ago to now over 700,000. Because of this, he can now comfortably charge over $2,500 for a few hours of his time as a consultant. The list is endless: mobile dog grooming, dry cleaning, delivery and pickup, mobile locksmiths, mechanic, and that's just to name a few. It's all about playing to your strengths and finding a unique mixture of skills that can add a lot of value to your customers. Maybe it won't make you $1,000 in your first day, but with some hard work and dedication, you could absolutely scale it up to $1,000 a day and beyond. Next up is reselling. I'm talking flipping items from garage sales and charity shops. I'm putting this at number 3 on the risk scale, as with this strategy you will have to purchase the items before actually selling them. This means that if you make a mistake or buy something no one wants, you may be stuck with the item and no profit. At garage sales you will have lots of motivated sellers because they probably just want to clear out their house. This means some valuable items get very easily overlooked. Just think how many priceless Pokemon cards were sold at garage sales. When I was younger, this wasn't as easy to do as I didn't have a phone with an internet connection, but nowadays you have such an advantage. Of course, it helps to do some research before to know what you're looking for, but whenever you're unsure about the item, all it takes is a quick check on eBay to see what the market value is. You even have the advantage of putting your negotiation skills to the test. If you can manage to get the price down, you'll make even more profit. I recently turned a $100 purchase of second-hand model trains into just over $1,000 because 2 of the items happened to be very rare. I gave a fair price based on what I thought I could sell everything for, and then as luck would have it, I had people fighting over them on eBay. I had a bidding war on my hands, and it's a great thing to watch as the price just keeps going up and up and up. You could spend the day hunting for hidden gems and then go home and sell them on global marketplaces like eBay, Etsy, Amazon and Facebook. This is the perfect way to sell them, as online shoppers can be lazy and not everyone can be bothered to go and find a good deal. Of course, you don't have to buy products at charity shops and garage sales. You can turn to the internet instead and hunt for some great deals. A good strategy I've used is searching for common spelling mistakes, as this allows you to find listings that no one else has seen, and therefore there's less competition when you're trying to bid for the items. I work out what I can sell the item for and then I offer 50% or less. I aim to at least double my money. And who knows, maybe you'll even scale this into a real business and begin buying inventory in bulk. I really believe that with a bit of skill and a large range of garage sales, you would be able to turn $100 into $1,000 within 24 hours. Let's now talk about buying materials to create physical products. I'm putting creating your own products as number 4 on the risk scale, as it does require you to have some creative skills and also the ability to do some proper market research to make sure people want your product in the first place. But with that said, by making your own products, you can generate much more money than reselling, as you're only paying for the materials. This means you have a much higher chance of securing that $1,000 profit per day. When I was younger, I used to build literally hundreds of radio controlled cars. I was friends with a model shop owner, and I noticed that many customers didn't want to build their own cars from scratch, as all they wanted to do was race them around. So after identifying this demand, I decided to buy the materials and charge a minimum of $30 for my time. It took me 2 hours to complete each model, so in 24 hours I could make $360. But that was way back in the 1980s, so you could definitely charge more for your time now and possibly hit that $1,000 mark. This could apply to so many areas, and all you need to do is promote yourself online, be it building model cars, making arts and crafts, or even building furniture. Now that takes me back to my carpenter days, that's for sure. Now let's get into crypto trading. I'm putting crypto trading at number 5 on our risk scale because it's such a new investment, which means certain coins can be extremely volatile, sometimes even shooting up over 1,000% within a few days. Of course, this is very exciting, but it also means the opposite is true and you could end up losing all of your money. You may be wondering why I've skipped investing in stocks and dived straight into crypto. The truth is, it's just not very common to make $1,000 from $100 investment in the stock market over a 24-hour period. Of course, it's possible with certain penny stocks and short squeezes like the GameStop situation, but these are often hard to spot. Because of the juicy returns from crypto, I've actually noticed a decline in the amount of people interested in the stock market, especially from the younger generation. The thing to remember here is that although stocks might not be as exciting, they can still offer some great returns over the long term and have been around a lot longer, so are generally regarded as a safer bet. On that note, public.com is currently giving away a free stock worth all the way up to $1,000 if you're in the USA, and Freetrade are giving away a free stock worth up to £200 if you're in the UK. I'll leave the links in the description below. But back to the crypto, a crazy statistic I found was that 13% of all
Black Monday.
They're calling it the Monday Massacre.
Wall Street had its biggest one-day drop in history.
The results of the decline will hit millions of people.
Up until this point, your friends probably thought you were some kind of genius, but now they're urging you to sell. But you ignore them, and slowly but surely the market recovers until
the Nasdaq index in freefall, down nearly 10%.
Driven by technology in general and the internet in particular.
Traders and investors shell-shocked.
your friends are on their knees begging you to pull your money out, saying things like it's time to take your profits before you lose everything. But you hold strong and things start going back up until you're hit with...
It was one of the most profound events in generations with huge consequences.
Little did you know, you're in for the ride of a lifetime until...
The global economy will contract by 3% this year, the worst downturn since the Great Depression.
Surely this is the end of the stock market. But as things reopened, the market soared 27% from its low, setting new records. What a comeback. Something I didn't mention is the guy that invested his money in 1985 was actually me when I turned 18 years old. The average return over this time period was 11.23% per year. So if I'd have only invested $250 per month during this time, then I would have made $1,841,521.08. That's a return of over 6,000%. But between us, I invested a lot more than that. So now you understand the power of investing, I think it's time to jump into the details. Honestly, it's amazing how many people talk about investing, but don't actually show you how to do it. So I'm going to quickly walk you through how to invest in stocks on your phone. Of course, remember, I'm not a financial advisor. This is just the way I do it. And before you do any of this, make sure you have an emergency fund of 3 to 5 months of living expenses. The first thing on our list is to set up an account. A lot of people get stuck at this stage as there's a lot of different investment platforms out there and also different types of accounts. But trust me, it's much more simple than it first seems, especially now you can do it all online. When I first started investing, I had to phone up the stockbroker every time I wanted to buy a stock. Let's use the Trading 212 app. I'm going to be using my son's account as my account's pretty messy as it has a bunch of free shares. He's actually been running an experiment on here for the last 3 months, but we'll talk about that in a bit. The account you open should be a tax advantaged one. This means you won't have to pay any unnecessary taxes. These are known as stocks and shares ISAs in the UK and Roth IRAs in America. I think the UK option's much better as you can invest up to £20,000 a year without paying capital gains tax on your profits, and you can take out your money whenever you want. In contrast, Americans have to wait until they're old and retired, and they have a much lower limit of $6,500 per year. Feel free to use whatever app you like. This is just one of my personal favorites. Next, we need to deposit some money in order to start investing. Most apps make it pretty easy to deposit money. We just have to click these 3 lines and then select deposit funds. As you can see, this brings up a screen with lots of different options like instant bank transfer, debit card, and what we're going to use, Apple Pay. Let's just put in 400 so we can invest in some stocks together. Feel free to invest whatever you feel comfortable doing. Curtis, I'm going to need your face for the phone.
All right, hang on.
This next step is super important.
getting some free stocks. Since I was planning to talk about Trading 212 anyway, I reached out to them to see if they would be interested in sponsoring this portion of the video. They agreed, and they're offering a free stock worth up to £100 to anyone that uses the code Tilbury when they create an account. Plus you can get more free shares by inviting your friends. Both of you will get a free share as long as they fund their account. So don't waste your invites and invite brokies. And also don't worry if you've already opened an account within the last 10 days. You can still use the promo code Tilbury in the app and receive your free share. Right. Now we need to plan a winning strategy. The first thing we need to remember is that investments go up and down, so it's very hard to pick winning individual stocks. That's why I prefer to invest in all of them. You probably think this sounds a bit crazy, but stay with me. I love listening to music. I'm a big Deacon Blue and Queen fan myself. But whatever you like, if you've ever listened to the radio or used Spotify, you'll be familiar with the music charts. The better the songs perform in sales and downloads, the higher up they go in the charts. On the other hand, if a song drops in popularity and sales, then it drops out of the charts. This is almost exactly the same as investing in an index fund. All you have to do is switch out the songs for companies. Let's take the S&P 500 for example. This is a list of around 500 of the largest public companies in the USA. The big dogs being Amazon, Google, Apple and Tesla. And just like the music charts, if a company does poorly, then they risk being removed from the list. Here's the cool part about an index fund. With just one click, you're not just investing in one or two companies, but in every single company on the list. So if one doesn't perform very well, your money's okay as you're spread across all of them. So how can we put this into practice? Well, we need to automate our long-term investments. Remember I said my son had been running a little experiment for the last 3 months on his account? Well, he's been investing £5 into the S&P 500 every day. Why £5? Because that's about the average price of a Starbucks coffee. Automating your investments like this is a great idea, as it means you can just set it and forget it. His portfolio is actually doing pretty well. As you can see in the green, his return so far is £36.46, and that's a return of 5.03%. Not bad for a little experiment. You can get financially ahead. And if you're older, then use this as a checklist to make sure you're on track. I promise, if you just implement a few of these things, you'll be so far ahead of everyone else, they won't even believe you. I managed to become a millionaire in my 20s. However, if I watched a video like this when I was younger, then I'm sure I could have made my first million much faster. Don't just watch the part of the video that's for your age. You need to do all of these things. And if you skip steps, you might end up regretting it. Right, let's kick this off with age 13. When it comes to investing, the hands down most important thing is time in the market. But what does that actually mean? Well, put simply, you want to have your money invested for as long as possible so it can start growing rapidly, like a snowball rolling down a hill and eventually turning into an avalanche. So if you're actually 13 or younger and you're watching this video right now, I think all us oldies would agree that you're in the best possible position. So how do you actually start investing at this age? Well, as you're currently not of legal age to invest on your own, you're going to need to convince a parent or guardian to open up something called a custodial account. Now, I understand it might be hard to speak to your parents about money and investing. My parents never ever spoke about money at all, let alone investing. So if you want to, feel free to show them the next 30 seconds of this video so I can help persuade them to open up one for you. A custodial account is an investing account controlled by an adult for the benefit of a minor, typically a family member. These have different names depending on where you live. In the UK, we have something called a Junior Stocks and Shares ISA, which lets your parent or guardian invest up to £9,000 a year on your behalf. Now, of course, they don't have to do this much, but just think, every birthday or Christmas, you could ask them to put some money into the account and invest in some stocks and shares. I'm not a financial advisor, and this shouldn't be taken as financial advice. However, over the years, I've just invested in a simple low-cost S&P 500 index fund. This invests your money across just over 500 of the biggest public companies in the USA, so you don't have to worry about picking individual stocks. The historical average yearly return of the S&P 500 is 12.58% over the last 10 years, as of the end of May 2024. Of course, investments can go down as well as up. If you've got a Junior Stocks and Shares ISA, then you'll be able to start managing it for yourself from the age of 16, and you could start to withdraw money from the age of 18 if you wanted to. But if you're anything like me, once you've got the investing bug, you'll probably want to keep it growing. In America, you have two main options, a UGMA and a UTMA. These both have unlimited contributions, but you could trigger gift tax if your parent or guardian puts in more than $18,000 in 1 year. The only real difference between these two is that with a UTMA, you can also invest in real estate and fine art. A custodial account can be set up with most banks and brokerages. My favourite is Vanguard for both the UK and the USA, as they've pretty low fees and they've certainly been around for a long time. So if you're younger than 18, then please, please, please promise me you talk to your parents about getting one of these accounts, as it gives you such a head start. Right, moving on to age 14. Besides time, another huge advantage you have at this age is that you probably don't have to pay rent and other monthly bills. This means you have the freedom to try different ways to make money, since you don't need a reliable income every single month. You should go out and try everything from cleaning driveways with pressure washers to competitive sports. Not everything has to be about making money. You can learn a lot from other activities, which you can use to make money when you're older. My son Curtis used to get up at 4 a.m. most mornings for swimming practice. Of course, he didn't earn any money from this, but it did teach him discipline. So when he started his business at 18, he could outwork his competition. I speak to so many teenagers who tell me they don't have a talent, but when I ask them what their hobbies are, they can't even name a few they've tried. You can't expect to find your talent if you don't try a wide range of different things. If it doesn't work out, then that's absolutely fine. Just try the next thing and the next. When you find something you're naturally good at or enjoy getting better at, double down on it and make it your mission to become one of the best. Next, age 15. One of the things I miss most about being younger is birthday and Christmas presents. Not that I got a lot, as my parents weren't very wealthy, but I definitely got more than I do now. That's just the reality of growing up, especially for young men. So instead of asking for presents like PS4 games and other things that you're not really going to care about in less than a few months, a huge life hack is to ask for cash whenever possible. I'd also highly recommend going and getting a Saturday job. Now, don't be too picky at this stage. Even working in a retail store behind a counter can earn you a nice bit of extra money. You'll also learn a lot of useful social skills that will prepare you for the real world. Doing both of these things will help you start stashing away cash, as long as you avoid the temptation to spend it. I like to use the word stash instead of save, as I have a problem with the way most teenagers approach saving money. They will save for months and then go and spend it all on a new game console or a day at the theme park. Now, obviously we all like a roller coaster, that's for sure. This shouldn't be what you're stashing your cash for though. Of course, you should spend some of it to have fun. However, see your stash more like a launch pad that you can use to make even more money. The hardest thing in the world is starting with $0 to your name. So if you can avoid that, even if you have as little as $100, then it's going to make everything so much easier. Oh, and I almost forgot. Go and apply for your provisional driving licence. In the UK, you can do this when you're 15 years and 9 months old, so it's worth getting, even if you don't intend to start using it right away. Right, now it's getting serious. Age 16. You've got a 2-year window before you enter the real world, so it's time to really think about what skills you're going to start focusing on and developing. By now, if you've done all the things I've mentioned in this video, then you should have a pretty solid idea of what you're good at. These may seem unrelated at first, but pick a handful of them and start stacking your skills on top of each other. When I was younger, I was talented at selling, designing mechanics and woodwork. So I invested my money into different things that would help me get better at those skills. Now, I had no idea how I'd link them together, but I trusted that in the end, it would all make sense. I'm not really talking about buying courses, as there's so many fake gurus out there just trying to scam you out of your money. With that said, there are some good ones around as well. Even better though, if you can find some sort of community to join where you can chat and learn, so much the better. However, the majority of your money should be invested in equipment. I remember when my son bought his first iMac for $500 from his uncle. He did this with the money he'd saved from doing part-time jobs. Because that was the biggest purchase he'd ever made at the time, he would sit at that Mac and learn everything about it. This led to him teaching himself how to edit videos and use Photoshop. Investing in tools like this can really open so many doors. Between now and 18, your biggest aim should be to develop these different skills that you can later use to make more money than someone that just decided to play video games. This is because you can come into the real world with some actual value to offer. This heavily cuts down the amount of training a company needs to give you, which takes the burden off them. On to age 17. Now listen to me very carefully. You need to pass your driving test. Yes, I know you probably don't need to drive anywhere at 17, but trust me, the sooner you do this, the better. In some states in the USA, you can do this as early as 16. Remember, you only need to do it once. Not being able to drive is one of the biggest things stopping most people from starting a side hustle. I mean, what if you have the chance to work with a client but they live 30 minutes away and you can't get a lift every week? You'd have to rely on public transport, and we all know how unreliable that is. You'll probably end up getting a bad name for yourself and coming across as unprofessional, leading to that opportunity going out the window. One of my key rules to this day is to be early is to be on time. To be on time is to be late. And to be late, well, that is unacceptable. So if you're watching this now and considering driving lessons, do it. Please don't be that person that regrets not jumping on it sooner. Yes, it might be a bit scary at first. I thought it was really exciting, to be honest, but think about the bigger picture. Once you've learned, you can use some of that money you've been stashing away to buy yourself a cheap starter car, then nothing's holding you back. Now it's time for the big one, age 18. The world really opens up to you once you turn 18. Now you're officially classed as an adult, and there are so many things you can do to get financially ahead. I wish someone had sat me down on my 18th birthday and told me exactly what I needed to do. So that's what I'm going to do for you now. I've made a checklist of 7 things you need to do to set yourself up for success. Even if you're over the age of 18, it's super important you do all of these things sooner rather than later. Let me know in the comments how many you've ticked off. Number 1, open your own bank accounts. Having your own bank accounts that only you have access to is the first logical step you should take once you're over the age of 18. I say accounts because really and truly, you should have 2. The first is a current account, or as the Americans call it, a checking account. This is where your money should flow in and out. For example, let's say you got yourself a job at a coffee shop. The coffee shop pays your wage into your current account, and then you can use that money on whatever you want, really. The second is a high interest savings account. This is where you should start building up an emergency fund of 3 to 6 months of your living expenses, just in case something out of your control happens and your income dries up. It's like when you chug a big pot shield potion on Fortnite, but keep some minis handy. So where should you open up these accounts? Well, you need to be looking for banks that don't charge high fees. I remember I used to get charged for stupid little things all the time. Having these accounts shouldn't cost you money. I also think you should have 2 accounts with different banks, as it makes your savings way less easy to spend. When it's out of sight, it's out of mind. If you're in the UK, then I'd recommend going with a challenger bank like Monzo for your current account. Now, this isn't sponsored, but their app is genuinely very good. For your savings account, Chase is a great option as they're currently offering 4.1% interest on your money, so you'll get paid for just leaving your money in the account. In the USA, I'd recommend looking at Ally Bank or Bank of America because they offer minimal fees and have really strong online banking service. Number 2. Get a credit card. When I was younger, I believed that if you never borrowed, you'd have an amazing credit score. Since you never took out a loan or made any late payments, it makes sense, right? Well, that couldn't be further from the truth. Taking out a credit card when you turn 18 is the perfect tool to build up your credit score. You can do this by using your credit card to pay for the things you would normally pay for in cash, like paying for the gas in your car, for example, and then paying the card off in full every month without fail. Using it this way will ensure that you never get charged any interest at the same time as building up your credit score. A credit score is kind of like your Uber rating but for money. Banks look at this and then they decide whether or not they're going to give you a loan. And if they do, what interest rate they're going to charge you. Now, lots of people are against the idea of getting a credit card because they're taught from a really young age that debt is bad. I know this because that's exactly what I was taught. My dad would always say, never a lender or a borrower be. This was a saying that originally came from rich people years and years ago to keep the workers down, as they knew by borrowing, the working class could create wealth for themselves. The rich wanted to keep getting richer and keep the poor in their place. If I had a credit card when I was 18, it would have been much easier to get a mortgage sooner and buy my first property. I would have also been able to borrow more money at lower interest rates. Now, that may not sound significant, but over a long period, like a mortgage, this can really add up. Number 3, open an investing account. The key is to open the correct type of account. You'll often hear people throwing around terms like Roth IRA in the USA, stocks and shares ISA in the UK, and TFSA in Canada, and supers in Australia. So if you don't have one of these accounts, then you're missing out, as they allow you to avoid having to pay taxes on your investments, but they do have limits because they're extremely powerful. Nowadays, opening an investing account is very simple, as you can do it all from your mobile phone. A great thing about these investing apps is that it actually gives you the ability to buy fractional shares. So rather than having to pay $220 for an Apple share, you can invest as little as $1. Now, I wish I had this option when I was younger, as it would have allowed me to get in some early experience with investing without having to take any big risks. One of my favourite investing platforms is Trading 212, as they offer fractional shares and also stocks and shares ISAs. Since I was planning to talk about their app anyway, I reached out to them to see if they'd be interested in sponsoring this portion of the video. They agreed and are offering a free stock worth up to £100 to anyone that uses the code Tilbury when they create an account. Plus, you can get more free stocks by inviting your friends. Both of you will get a free share as long as they fund their account. If you aren't quite ready to invest for real, one of the really cool things about Trading 212 is they let you practice investing with fake money. You can get familiar with the markets using real data without risking any actual money. So if you're a little uncomfortable with investing or just want to try out some strategies before putting your own money on the line, this is a great way to get started. Also, don't worry if you've already opened an account within the last 10 days. You can still use the promo code Tilbury in the app and receive your free share. So feel free to pause the video right now, get your free stock, and then continue watching. Number 4. Carefully consider university. So many teenagers have asked me, is going to university a scam? My answer is always yes and no. On one hand, for some careers, you certainly need to go to university, like doctors, nurses, and teachers. There is a direct result from doing university courses like this. You get a degree and the career path opens up to you. These professions play critical roles in our society, directly impacting the way we function. So, are absolutely not a scam. I actually think these types of courses should be free and reserved for the people with the best grades and passion for following one of these careers. However, on the other hand, there are a lot of other courses out there that don't open up job opportunities directly, and therefore, why waste your money and, more importantly, your time studying at university for something you don't really need? Skilled trades like plumbing, entrepreneurship, and tech, well, they don't require a degree. It's more about how good you are at what you do. Your track record and results will speak for itself. I mean, I read through my comments on here and I've seen lots of people claim they've learnt more from me than they did in their business degree. Now, that really says a lot. For me, and for a lot of other employers, it's more about your practical experience and attitude than anything else. So please, don't be pressured into going to university to study something you don't care about and waste 4 years of your life. I mean, I heard there's a golf management degree now. How ridiculous. Multiple shops and warehouses. Then, almost overnight, the internet made it irrelevant. I had 2 choices, give up or adapt. You know me, I wasn't about to quit. So I threw myself into learning everything about making money online. And like most people today, I fell for the hype. I tried every method out there, and guess what? None of them were as easy as people said. But through trial and error, I cracked the code and rebuilt my businesses, but this time with the internet at the core of my strategy. Fast forward to today, and making money online isn't just important, it's an essential thing everyone should be doing. That's exactly why I'm making this video. I spent years testing, failing and refining, losing millions, making millions, and learning what actually works. Now with this knowledge, I can help you avoid all the mistakes and fast track your success. So if you're tired of false promises and ready to commit for the next 6 to 12 months and build something real, this is for you. No gimmicks, no BS, just the process that actually works. All right, so this is the online wealth wheel. And whether you realize it or not, you're already on it. There are 3 main stages that define where people are in their journey to making money online, plus a secret 4th stage that only a few ever reach. We'll discuss that one at the end. Let's kick things off with stage 1. This is where everyone starts with no side hustle. And sadly, 55% of people never start at all. Inflation is making everything more expensive. And let's be real, relying on a single paycheck is more dangerous than ever. So if having a side hustle is essential, why do 55% of people still avoid it? Because the online space is a jungle. It's full of ads pushing proven methods that confuse more people than they actually help. The key to starting the right way is picking a method that suits your skills, budget and lifestyle. If you already have a skill like video editing, graphic design, coding, or even setting up Discord servers, people pay great money for these services and there's no shortage of demand. But what if you don't have a skill to sell, or quite simply don't want to deal with clients? That's where product-based businesses come in. One of the best options is selling products online without ever holding inventory yourself. But I'll get into this in more detail later on. That brings me on to running a failing side hustle. I'm classing a failing side hustle as earning less than $50 per month online. Sadly, 28% of people are trapped here. A lot of people aren't going to like me saying this, but it has to be said. It's almost never your side hustle that's flawed or doesn't work. You're most likely just not putting enough time and effort in. I know that can be hard to hear, but this isn't really your fault. It's down to something called shiny object syndrome. This is when you constantly jump from one trendy online money-making method to another without committing and putting your absolute all into any of them. One week it's drop shipping, then print on demand, then selling books on Amazon KDP, then trading stocks, and then starting a social media agency. The truth is, all the online money-making methods I just mentioned work, but each requires a different level of time commitment, and you'll never get anywhere by jumping from one to the other. It's like that classic diagram of miners tirelessly digging for gold, only to give up just before striking it rich. Instead of pushing through, they abandon their progress, start fresh somewhere else, and waste all that initial effort repeating the cycle over and over again. If you get stuck in this dangerous pattern like the 28% of other people, then you need to recognize it and simply pick a method and stick to it. Forget the idea of a perfect side hustle. Just pick one that's easy to start and has the potential to scale. If you don't have a high income skill to sell, then I'm going to make this super simple for you. In all my years of experience, the thing that has made me the most amount of money online is e-commerce. So I recommend you focus on that, but not in the way most people do. A lot of beginners assume starting an online store means dealing with inventory, suppliers, or complex setups, but that's not the case anymore. That's because you can now utilize AI-built Shopify stores. Instead of spending weeks setting everything up like I had to back in the day, you can now use a free tool called buildyourstore.ai to launch a fully automated store that would normally cost $200 to $300 to set up, but this does it for free in a matter of minutes. You just enter your name and email, pick a niche like fashion, tech or pets, and the AI chooses winning products, designs your store and makes it look professional from day one. If you want to go through this process completely for free, then just click the link in the description and it'll walk you through everything. From there, it syncs directly with Shopify, giving you exclusive access to a 3-month Shopify trial for only $1 per month. But what about making sales? Well, the biggest mistake people make with e-commerce is giving up too soon. Surprise, surprise. This is probably because they don't want to deal with inventory or fulfillment. That's why the free AI Store Builder also walks you through how to integrate a tool called AutoDS, which is kind of like the autopilot system on a plane. It imports trending products, updates pricing and images, and even ships orders directly to your customers. This means you don't have to touch inventory, package anything, or deal with supplier negotiations. You focus on driving traffic and making sales while the system handles the rest. Full disclosure, AutoDS are long-term supporters of this channel, but even if they weren't sponsoring this portion of the video, I'd still recommend them. You can easily create a buzz around your products by creating videos about them on TikTok for free. If you get 100k views and just 1% of the people go and buy your product for $10, then that's $10,000 in revenue. So if you're serious about breaking out of the failing side hustle trap, then choosing a simple automated model like this gives you the best chance at success. No more bouncing between business ideas, just commit, launch, and put in the work to scale it up. Stage 3 is running a successful side hustle. Believe it or not, only 16% of people who start making money online ever make more than $50 per month. The people in this percentile make anywhere from $51 on the low end all the way up to $10,000 a month. Of course, the higher end is what I'd consider actually successful. So what are these 16% of people doing differently, and how can you start applying it to yourself? Well, there's some clear things that I've noticed that separate the people who struggle from those who actually make money online. And to help you get there, I'm going to break them down into 4 key steps that you can follow. Step 1 is to stop trying to appeal to everyone. You might think casting a wide net will get you more sales, but in reality, it does the opposite. If you try to appeal to everyone, you'll appeal to no one. So before you even start promoting your store, grab a notepad or open your notes app and describe to start investing all over again. I'll do things a little bit differently. So if you can follow all 5 of these steps, then you'll be well ahead of me when you get to my age. Step 1, adjust your risk tolerance. In hindsight, I realized that I may not have taken as many risks as I could have during my younger years. The reality is that in your 20s, you typically have more time than money. This means that any risks you take have minimal downsides compared to those that have families and a mortgage. This is the time to build your empire, so being scared of taking risks is actually the most dangerous thing of all, as it means you'll fall short of your full potential. Of course, you should do everything in your power to swing the odds in your favor. However, you won't be able to eliminate risk entirely if you want to become wealthy. There is still going to be some risk in every opportunity, as nothing good ever comes easy. When times are hard, people are much more likely to let that little bit of doubt get inside their head and talk them out of whatever they want to do. I've seen countless friends say they're going to quit their job to start a business, but they never make that leap because they don't want to risk their comfortable income. When I'm judging whether or not to make an investment, I compare the potential risk with the opportunity cost of not taking that risk. Opportunity cost is what you give up when you choose one option over another. Thinking about this helps you make better decisions about how you use your resources. I'm not saying I always make the right decisions, but on average, I've come out profitable when I've used this tactic, and I also never want the thought of what could have been eating away at me. So the best way for you to grow your wealth is to take calculated risk with your money and use that time to grow your wealth faster than everyone else. Step 2, set it and forget it. I definitely should have automated my investments a lot sooner, as it forces you to prioritize your investments as the money is taken before you can spend it. This is when you arrange to have a fixed amount of money taken out of your paycheck or bank account every month and put into a predetermined investment. Investing $100 in an S&P 500 index fund is a good example of this. This will allow your wealth to compound over the years without you ever having to really think about it. This is a very straightforward process. First, determine how much money you want to save and from which account. Then go to an investment app and look for an automatic investment option and choose how you want to invest. They'll do all the paperwork. Once you sign off on the bottom line, the automated magic begins. In my experience, the majority of people that lose money when investing waste their time trying to pick the right stock at the right time. And if you've been watching my channel long enough, you'll already know that it's not easy to time the market. For me, investing is all about growing your money over the long term. ETFs allow you to invest in an entire market quickly and in a single transaction by tracking the performance of an index. You can choose to invest in specific regions like the top 500 companies in America with the S&P 500, the entire stock market, or even specific sectors like tech. Invest Engine is a Which recommended provider and is a platform that really resonates with me as their entire focus is on long-term ETF investing. They offer ISAs, which are essentially fortified investing accounts protecting you from taxes. Because no one likes the tax man. With ISA accounts, you can only invest £20,000 per year, but any profits you make can be withdrawn completely tax-free. So I definitely recommend creating an ISA account with them and protecting your returns. If you sign up to Invest Engine today using my link, you'll receive a £25 welcome bonus when you invest your first £100. So you can get a 25% return on your money from the start. They even have an auto invest feature, which invests any cash that hits your portfolio straight into the ETFs you pick. So you really can set it and forget it. Thanks Invest Engine for sponsoring this portion of the video. Step 3. Avoid temptation. I understand why people were drawn into the crazy crypto investments a couple of years ago, as this was similar to penny stocks back in my day. When there's a craze like this happening, lots of people feel like if they don't invest, they'll lose out on an amazing opportunity. So they start investing in things without fully understanding them. This has to be one of the most risky things that you could ever do, and it's probably the biggest investing mistake I see people making. I speak from experience. I made a few lucky investments in penny stocks when I was younger, and had I continued on that path, I would have lost everything. To be more exact, I had the opportunity to invest in a big group with a couple of billionaire friends. Everything they touched seemed to turn to gold. I can't reveal